fantastic to have you on ET Now. Thank you for joining us.
Wishing ET Now and its viewers a very happy anniversary. I heard it. Today is your anniversary.
Yes, you heard it right, my friend, and thank you for your wishes. It is our 13th anniversary, and it's not a great day to celebrate, but I'm sure that when we will look back and analyze our 13th anniversary for long-term investors, this would be a great day to buy.
True. And hopefully also.
Are we reaching that point of maximum pessimism, Naren? Because everybody has got a long list of what could go wrong. Nobody's talking about what could go right.
No, what we like to see at maximum pessimism, I don't think we are yet there. Globally, there are maybe places where we did see, like China in March, for example. But in India, we have had such fantastic domestic investors who have not allowed the point of maximum pessimism to come in. Actually, from that point of view, I think we are closer to the point of maximum pessimism maybe in Indian debt, because Indian debt never performed in the last few years. So I think maybe in a few months from now, Indian debt will become a very interesting asset class, and debt mutual funds will become very interesting, because over the last 2 years, debt mutual funds had zero interest or negative interest, I would say. But I do not think that equity, we are possibly at that point of maximum pessimism. And that's the reason, over the last 1 year, we've been talking asset allocation, and SIPs. And as you know, Nikunj, we've been talking about a central bank bull market in 2021. And when that ended, we always knew that there is going to be a problem. The central bank bull market ended. Now we're having a central bank bear market. So we need to know how the central bank bear market ends. The central bank bear market ends when Mr. Jerome Powell comes and says, now I'm through with the hiking cycle and I'm going to stop hiking, or I'm going to do quantitative easing. Sitting in India, are we able to predict when they're going to do it? That is a question that I think we have to ask ourselves. So we had a central bank bull market which pulled stocks to much above fair value. A central bank bear market can pull stocks to much below fair value also. And we are in that phase where we could be in a central bank bear market. And that is the problem at this point of time. It has nothing to do with equity investors. We are all small people. And how far this central bank bear market will take people, that's a question for which we don't have answers. We are going to be watching the Fed. We are going to be watching Mr. Jerome Powell. And we will see how long he is willing to allow a central bank bear market. My own view is they can't afford it to be long. So hopefully in 3 to 6 months' time, they will end a central bank bear market. And that is what, maybe that's my wishful thinking or my hope. I don't know. One of the two at least is there.
I'm just going to mark the markets right now. What do we have? We have a uptick coming in Nifty. We do have a marginal improvement in market breadth, but the selling is nowhere close to what we saw in the second half of trade yesterday. But frankly, the technical setup of the market has become so choppy and so different that all bounces now would actually be sold into the market right now. So Naren, while we may say,
just some other movers, and sorry to interrupt you here, while of course the index is recovering and we are back at that 15,300 level, the good thing is that the losers are not as deep, or rather the cuts are not as deep or anything close to what they were in yesterday's trade. So your top loser within the F&O universe right now is Indiabulls Housing, which is down only 3.6%. And I say only because yesterday was a very, very bad picture. NBCC, Petronet, Jubilant Foodworks, Idea, they're at best 3 to 3.5% lower only. Much of an improvement actually from yesterday. But Nikunj, I think Naren is back with us.
Yep. Naren, the fact that FIs are selling and DIs are buying, and that is not creating nervousness in the market. Are we reaching that point where, because last 1 year returns have been almost zero for schemes now, and if this selling continues, it could be negative also. So are we reaching that level where psychologically we may actually seeing outflows and then that is the time when markets will bottom out. I mean, that's bad news for all of us. But would you wait for that event to happen?
See, that's a possibility, and that can't be. That can't be said, can't happen. But that would be a buying opportunity with a contrarian mindset. So if that were to happen, we would be recommending not asset allocation. We would be recommending equity at that point of time in an aggressive way. So that is a possibility. And today, whatever valuation models that we follow, even today, surprisingly, our valuation models are not saying that equities is very attractive. It is saying that equities is only fair. It is not attractive. So I would say that if there were to be some redemptions and markets were to go down from here, I think equities would become very attractive. And that is the reason over the last 6 months, we have been focused on systematic investment plans, systematic transfer plans, booster STPs, and asset allocation. And that is the framework that we have had to do. Although we always thought that central bankers run equity markets and not equity mutual funds. And that has been the challenge for all of us sitting in India.
Naren, when markets will come back, and I'm referring to equity markets, do you see a change in leadership? Because this year the change in leadership has already happened. Growth stocks have peaked out, IT stocks have peaked out, value stocks are coming, you're outperforming, energy stocks are outperforming. Do you think the leadership on the market or the leadership of the new bull market has already changed?
See, clearly, I think, we had, and I must thank that in India, we did not have so many loss companies belonging to new age businesses getting listed. There were hardly 3 to 5 companies which got listed, and many of them have already crashed. And so in India, luckily, we didn't have that segment becoming very big. But I think in other parts of the world, that is going to be the problem. Wherever in other parts of the world, you have hundreds of companies which are trading on revenue rather than cash flows. I think in those places, you're going to have a problem. But in India, we never had that many companies. We had hardly 5 or 6 companies. But clearly, when we look at sectors like chemicals, for example, they seem to be in some extremely high valued sectors. Some of the small caps in certain sectors look very overvalued. So maybe those areas will not form part of the next bull market. But I don't think we are going to have so much of a change, because if you look at sectors like financials, they have been underperformers for a decade. Infrastructure has been underperformer for a decade. So I think clearly manufacturing as a sector has to do well over the next 10 years. You can't have manufacturing do badly for long. So yes, some of the leaders for the next boom will be different, but at least it won't be like what you see in US, where you had so many loss-making companies becoming the darlings of the market. And in India, maybe sectors like chemicals may go out of fashion, but not that there'll be so much of change like what I expect to see in US.
Naren, for the Aam Janta out there, for the retail participant, I think, one would have to really have a psyche change, because all those new investors who came in at the COVID lows and made that excellent amount of quick money in the last 2 years, that may not happen, because while sure enough the market has crashed, but the recovery may not be as V-shaped as was in March 2020 and thereafter. That aside, the bigger worry is inflation. Beyond a point, all you want to worry about is how easy your life is, and everything from your petrol bill to your food bill to just about everything is expensive. But how is it that you can make your portfolio inflation proof? Is there some tactical strategy that retail investors out there can adopt to try and beat inflation in their portfolios?
Yeah. First is that investor expectations in between had gone to very high levels, as though making money in equities is too easy. Making money in equities is too easy. Why do you have to do hard work in so many areas? So I think once you bring down return expectations to lower levels and you believe that equities is a long-term asset class, I think some of the problems go away. And clearly equities is beneficial in an inflationary environment. And unlike 2020 and 21, I believe in a quarter or so, debt also will deliver much more reasonable returns. And in terms of the coupons that you're going to get in most of the debt mutual funds, because the yield to maturity on many of the debt mutual funds had gone down to very low levels in 2020 end. I think in 3-4 months after 2 more rate hikes, you're going to get much better yield to maturity. So forget equities, even debt mutual funds will actually have a fair amount of products which will give you reasonable yield to maturity. So I think lower return expectations in equities, longer term expectations from equities, debt mutual funds across the board are all going to be experiences. And I'm hoping that investors don't believe that derivatives is an easy way to make money in the markets. I think that also, I'm sure people would have learned over the last 6 months, it is not so easy. So I think all these things will happen. And finally, once you have a moderate return environment, people reduce their return expectations and things will be fine. I don't think that's so much of a problem. I don't think Indian investors have made so many mistakes. I think the extent of mistakes that have been made in US has been much higher. You look at the number of loss-making IPOs that happened in US, they were very, very high. There was a category of IPOs called SPAC. And those kind of IPOs looked very, very illogical to me. They did not happen in India. So I believe the extent of mistakes in US were much, much higher because in US you had a one-way bull market from 2012 to 2020. The extent of the bull market in India is much, much smaller than the US bull market. So I think the extent of excesses that have to be removed in US is much higher than the extent of excesses that have to be removed in India.
Sure, I completely get your point. What I was referring to was investor psychology because, 2020 told you that making money was just so easy. But anyway, that aside, since you're talking about, Naren, excesses, have the excesses in the IPO market been removed? And are they now, any of them, in value zone after the kind of beating that they've taken here in India?
I was involved in investment banking between 90 and 94. And one of the lessons that we have learned at ICICI Prudential is that wait for one bear market for many of the IPO companies. Let the IPO companies deliver in a bear market or at least behave in a bear market. And after that, you look at them in a very big way. We are not talking about industrial groups which already have expertise of dealing with investors. And so I think in the next 2 to 3 years, we'll get an opportunity to look at many of those IPOs, but many of the IPOs will have to deliver into a normal economic environment. Let's see how they deliver. And then we will get a good opportunity. And, if you look at 99, 2000 IPOs, there was some companies like Infosys, they delivered beautifully. But there were so many IPOs in the IT space, whose companies don't even exist at this point of time. Similar thing happened in infrastructure in 2007. So of all the companies which get listed, some of them just, they don't deliver at all. So I think we have to watch some of these companies over a period of time. We have to watch the governance. We have to watch how they do capital allocation. And that is what at ICICI Prudential, our entire team is focused on across sectors. And whichever companies is focused on governance and focused on delivering, we will actually look at them and increase our allocation to those companies. And that is how we look at it. And all companies will not do the good governance, in our opinion, because they're not used to public shareholders. So they don't even understand what it means to be a public company, some of them. And this is our learning after looking at some of the infra companies which got listed in 2007. Luckily, we avoided many of them. And that was our biggest benefit at that point of time. So like that, here also, we'll have to be cautious in some of these companies.
Appreciate your time. So glad you could join us and make this special day extra special for us. Really appreciate your time and the fact that you've always accommodated time. You've been part of ET Now programming as an expert voice throughout the years. Thanks a lot for that.